Good morning, ladies and gentlemen. Welcome to the Tortilla Mexican Grill PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, I would just like to submit the following poll, and if you'd give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from Tortilla Mexican Grill. Andy, good morning, sir.
Good morning, everyone. Hope everyone is well. Welcome to our presentation on the 2023 full year and some of the things we're going to talk about, strategy going forward. I'm absolutely delighted to be sat here this time. I've obviously met lots of you before as the CEO of this wonderful business, and to welcome Maria on board and Brandon joining us today as founder. We'll do some intros in a second, but we've got quite a detailed presentation, which should answer most of your questions. Obviously, we're going to allow plenty of time at the end for some Q&A, and we'll work through as many of those questions as we absolutely can. So let's crack on with some introductions. Brandon, do you want to go first?
Hi, I'm Brandon. I'm the founder of Tortilla, probably holder of the record of most burritos consumed in Europe. That's probably as far as I need to go with my intro.
I'm probably getting close.
So, to all of you, so it's a pleasure to be here today to go with Andy. So he joined us, a new CFO, only a couple of months ago, and I bring with me over 15 years of experience from large food manufacturing companies. So I'm hoping that my previous experience in procurement, supply chain, food production, as well as sort of end-to-end efficiencies really complement Andy when we go into the next exciting chapter for Tortilla. I'm going to now hand back to Andy to do a bit of reflection on last year and his first month as CFO.
Yeah, I guess just to introduce, obviously I've met most of you before, but just for those that I haven't, my name's Andy. I'm now the CEO of Tortilla. I'm a science guy by background. Got a first in astrophysics many years ago, which I really loved studying that fascinating topic. And then I moved into accountancy, trained with one of the big four firms, mostly doing oil and gas back at the start. Some interesting times when I joined the Russian gas giant Gazprom. It was really interesting working in those businesses. It taught me the big company way of approaching things sort of methodically, and all of those elements. Wanted to do something more tangible, so I love eating out. I love restaurants, so I moved over to the restaurant industry, first at Gaucho and then obviously now at Tortilla. I just love the tangible nature of what we do, the people in the business and all those things, and the energy. So yeah, look forward to meeting you all at different points in the future. Okay, so we're going to start with some reflections. Obviously, I'm in a new role now, so it's important that we have a quick look at where the business is at presently. Maria will then take us through a financial review of 2023. Then we'll both talk you through the next chapter. What is our sort of strategic and operational priorities for this year and beyond? And then we've got a Q&A at the end. So I guess the first month as CEO, we've got a nice collage here of a lovely farewell trip we did for Richard. Obviously, he'd been CEO of the business for many years. It was great to get into the stores, and that's where you see the action in this business. That's where you really see. For me, it was fantastic because you pick up on lots of things that are brilliant and are working well, but you pick up on some things that can be improved. And I definitely intend, as part of my role, to spend a lot of time in the restaurants, and I want my team in the restaurants as well. So once a month, or we'll be working in the stores, everyone in the office, actually, in fact, starting today, payday Friday. So great to get that sort of energy going. What it highlighted for me, really, the tour, was the fantastic people we've got, such energy, enthusiasm, and such a passion for the brand. I find that really infectious. It's such a great thing to see. We're nothing without our people. High quality franchise partners. We've got really high caliber businesses we work with that do a great job of safeguarding our brand and providing a great experience for our customers. Fantastic national footprint now. I think on one day I travelled from Belfast to Edinburgh, and then the next day to Exeter, and then Norwich at one point. So we're in all corners of the UK, and that puts us in a really good place for future growth of this business. And lastly, and I keep saying this, we should probably put this first because it's probably the most important thing, if anything, is the product. We've got a brilliant product. It represents something quite different to others on the high street. It's hot, it's filling, it's customizable, so you can make it healthy, a little bit more unhealthy, fresh. You can make it hot, you can make it spicy. It's a great product, and we think it's very different to other options on the high street, and that's that's something we're confident about for the future too. As I said, I was really pleased to see the energy and passion of our employees. So I then made this this idea of running around 28 miles around loads of our London stores, and there's a video of it just now.
I'm the CEO of Tortilla. I'm running a little bit of a challenge today. I thought to myself, how can I match the energy of our employees and get around and do as much cheerleading around as many sites as possible? So yeah, looking forward to sort of finishing off and having a big burrito at the end.
No, that was a lot of fun. Some achy legs the next day, but it was great. And I guess leading on to that, but those that you don't know me, what do I sort of stand for as a leader? I have a very high energy style of working. I really love analysing and debating, but I'm someone that likes to get things done as well. I like pushing projects through. I like momentum. I like energy, and I like enthusiasm. Ultimately, I like achieving things. You know, last year I started running more regularly and set myself the target of running my first marathon in under 3 hours, which was probably a bit too optimistic, but I just about did it. And I sort of really I really like aiming high in life. And I think as a business, that's what we should be doing, and being bold and optimistic about the future. I've got obviously a commercial mindset, being a financial guy. I love strategizing. We're working in sort of 3-month sprints on certain projects. I like breaking things down short term, medium term. What are we going to do in 1 year? What are we going to do in 3 years? What's 10 years look like? I love the strategy side of decision making. And then I'm really passionate about burritos. I hope that comes across in the way that this presentation flows today. They're a great product. We've got a fantastic brand, thanks to Brandon, and we've got a great opportunity to expand across the UK and Europe. The customer is everything. We don't have a business without our customers, and we also don't have a business without our people. And these last 2 points cover both areas. Customer is everything, and we need to make sure that we're providing our customer with the absolute best food we possibly can at the best price. I mean, that's fundamentally mission statement number one. We need great people, and we need them to feel engaged and excited about that journey. And obviously those cultural builds will be something that we'll be focusing hard on. So I guess just good to take a quick look at where we're at. So we're nearly 20 years old now. Brandon started the business in 2007. We are by far the largest Californian burrito business in Europe. And no one is anywhere near our scale. We are years ahead of others. And so we have a big scale advantage that gives us a big advantage in our expansion plans for the future. And that's the case in Europe as well. And scale is everything in this industry. It's important, though, to recognise that we aren't where we wanted to be. You know, to make 4.6 million of EBITDA is not what we set out to do this year. But last year, 2023. But last year, it was a moment of a bit of a reset and a recharge for us, and recovery, really, I think is the word that we would use. 2022 was a difficult year for us in terms of inflation. We put measures into place to combat that as best we could, and we built on that in 2023. And actually, Maria's going to talk to you a lot about some of the things that we've done last year that will play a lot of success into this year as well. So we then talk about the next chapter really in this presentation a lot. This is an opportunity to reset and kickstart things from here. So where could we be? Well, this year we're going to be focusing on really high quality grade A locations and a strategic review of our mix of own store and franchise sites. We're going to talk more about that later. We're going to talk about all of these later, so I'll just cover them very quickly. Franchising growth, we're going to be opening 5 franchise sites this year. We've never opened 5 franchise sites in a year. Dead excited about that. It's working really well for us. Food. There's going to be loads going on this year on the food front. We're working hard on that. We're going to talk to you about some of that later. Really excited about the improvements and areas that we think there's opportunity there. Marketing, we're going to be doing more marketing this year than we've done before, and we're really excited to talk to you about what we think the opportunity is on that front. And lastly, we have invested in a team for success. We've got really strong individuals in the business over the last couple of years. We've recently appointed a food director, which we'll talk about in a bit. So that's the last piece of the jigsaw really for us, and gives us a great platform for the future. So very quickly, 2023, a really good year of recovery for us. 16% increase year on year in EBITDA, and actually on an underlying basis, it was even more, and Maria will talk about that. Franchising partnerships flourished last year, record years across loads of the sites, a huge increase in sales year on year. 7 sites opened, we fully integrated Chilango, we cracked on and launched some major tech projects, we strengthened the board. So it was a busy year, and it gives us a great platform for next year, 2024. So just very quickly, we've got a better slide on this later actually, but there's a fantastic opportunity for Mexican food in the UK and Europe, and some data points we're going to cover later on. But I just wanted to highlight the point that we are in a really strong pole position to capitalise on that. We are years and years and years ahead of our competition. There's been lots of promises over the years about growth. We're the ones that have delivered it, and we will be the ones that deliver it in the future.
Okay, going to now go in a bit more to the financials, but before we deep dive into the Tortilla financials, I think it's going to take a minute or two to look at the macroeconomy and how that's relevant to Tortilla. So it's probably no surprise to any of you that hospitality was hit hard last year with the high inflations and the sort of cost of living crisis, which resulted in cost increases and the demand dropping. And as a consequence, we've seen several restaurants close the doors down in the early 2024. But what is positive for the whole sector and Tortilla is that the supply chain constraints, while still being there, are easing, and so is inflation. And what you can see from the graph there is in the top right corner that the footfall data was really low in Q1 across the shopping centres, retail parks and so on, but it's starting to improve, and so is consumer spend, which you can see from the second graph. It's also starting to be increased slightly over the end of Q1. And that's obviously positive for everyone. What's really important for Tortilla, though, which have a high proportion of estate in London, is the recovery of London. More and more office workers are returning to the capital, and it's forecast to become that sort of trend to continue. And as the cost of living crisis is sort of easing a little bit and people get more confidence, you're also expecting to see more and more tourists coming to the capital. So the outlook from about H2 is really expected to start improving. Some of our highlights for the financials for Tortilla last year. It's really nice to come in as a new CFO, knowing that so many restaurants have struggled financially, and see that we actually generated 3.8 million from operations in cash flow, and that we have a really low net leverage ratio of 0.3. It's also good that throughout quite a challenging year, we still did manage to grow our revenue with 14% year on year to 65.7 million. That came majority from our new site openings, 7 new sites, but also an underlying like-for-like growth sales of 3.6. Not really high, but considering the challenging economy we were in, that's still growth. And that means that we grew our EBITDA at 16% year on year to 4.6. It's not where we want to be, and there's room for improvements, because we will talk through both myself and Andy in this presentation. But at least it's a growth and it's a recovery from where we were the previous year. Looking a bit more detail to the income statement, you can see that we grew the 8 million on our top line, and I'll actually show you a waterfall very shortly, explaining that in a bit more detail. What's really positive to see is the gross margin improvement. So we improved 90 basis points year on year, and our margin is starting to be stronger. It's really coming from some supply negotiations we did last year, which again I'll talk more about in a minute. That meant that we did recover our EBITDA up, both as an absolute number, but also as a percentage point, 10 basis points up year on year. And that's despite having sort of kept investing in head office staff. For example, we now have an IT director on board with some more experienced marketing people and so on. And we're now in a state where the head office cost is probably where we need to be by maybe 1 or 2 people that's sort of due to join in 2024, where we need to be for the sort of quite a few years ahead, and we can grow our business significantly without adding too much more head office cost. As I mentioned, happy to see the positive cash flow coming in from the business, but obviously disappointing that we're making a loss at the bottom line of just over 1 million, and that's something that we'll focus on. And both myself and Andy is confident that we're going to turn that around and be profit making again, like we used to be pre-COVID. Here you can see the waterfall of our revenue growth last year. We started off with 57.7 million back in 2022, and that year we actually got a VAT benefit from the government sort of support in Q1 22 of 800k, which also replicated last year. However, the major growth year on year was 7 million came from new openings, and you can see in the little table at the top right corner that out of that 3.7 million was a full year impact of the 2022 openings, and a further 3.4 million came from the annualized impact of the Chilango acquisition that was acquired in 2022, and again we got the full year impact last year. And then we opened some new stores, 6 new owned stores in 2023 that contributed just over 2 million in top line, but that was nearly all offset with the closure of cloud kitchens of just over 2 million. Of these 10 cloud kitchens we closed, 8 of those were actually closed in 2022, and it's just again the full year impact of it was 2 were closed last year. And once you can see it's a hit on the revenue number, they didn't really contribute anything on the bottom line. We then also grew our franchise up to 100k and had an underlying growth which contributed 1.5 million, bringing us to 65.7 million of revenue in 2023. Looking in a little bit more on the like-for-like sales, as I said before, we had a 3.6% like-for-like last year. In-store was more positive about up 3.8%, and if you take away the sort of VAT adjustment, that was actually over 5%, so not too bad. However, delivery was declining, down 2% like-for-like, and it's more sort of delivery adjusting back a little bit more to normal than it used to be in the COVID years when it was really high. But what we have as a percentage, both last year and the year before, is sort of stabilized around 30% of our total sales coming from delivery. And what we did in 2023, we traded across all 3 different platforms, delivery partners, to really protect our top line growth, which was maybe the right decision at the time. However, what that did and what we really reflected on since is that it's really hurt our margins, and hence we changed delivery strategy in 2024, which I will talk more about later on in the presentation. Looking at inflation, no surprise probably, but still quite shocking to see, if you see the left-hand side graph there, how high our protein prices was in the first quarter of 2023. But it really spiked up. Through sort of becoming bigger and having more purchasing power, we did manage to then negotiate with our suppliers and really bring our protein prices down towards mid-half year last year. And also now managed to hedge some of it. So we actually hedged our chicken prices for the full of 2024, and the other protein prices are hedged for the first half of 2024. So you can see that they're significantly lower than they were at the start of 2023, and expected to be so for the rest of this year, with 76% of our food basket having quite some certainty on the lower prices for this year. So while we saw a margin benefit in 2023, the full year impact of that will materialize in 2024. And quite a similar story of utility costs, where again we had high costs going into 2023. We actually changed our provider midway through the year, and again managed to negotiate much better prices. And we also changed to a hedging strategy, now hedging up to 60% before the delivery year starts, and we have already hedged 50% for the next delivery year starting in October this year, which means we're protected from those high potential winter cost increases that could come. And again, the full year impact of utility as well will feed through to our profitability in 2024. So that brings us on to the EBITDA waterfall graph. And what you can see here that once we reported 4 million EBITDA in 2022, we had 1.3 million really coming from government support, where they supported us both on the VAT and lower business rates. So without that, our underlying EBITDA was down to 2.7. So since then we've grown. Particularly, you can see the high, the proportion of these margin improvements I just talked about coming through, 800k. The new store openings also contribute a further 800k, and then our underlying growth bringing 300k to the bottom line EBITDA, bringing us to 4.6 in 2023. I'd like to show you a bit of the cash flow. So as I mentioned before, coming in as a new CFO, it's always some of you dive into looking at what the cash position of the company. Seeing 3.8 million from operation during a challenging year is really positive. And the fact that we also managed to put 2 million towards sort of maintenance costs to really make sure we look after our current state and still have 1.6 million left at free cash flow line is positive. However, what I don't really like seeing is that we only managed to fund 60% of a new store rollout with our own free cash flow. And that sort of low level is probably not sustainable for the longer term. And that's not where we used to be pre-COVID either. So both myself and Andy were really focused on returning to a situation where we can fund our new store rollout via our free cash flow. And that will come with the increased top line sale and increased profitability we're expecting in 2024 and beyond that we'll talk more about throughout this presentation. What's very positive to see is that, as I hinted on it before, is the low leverage that we have with only 0.3, and we only have a debt of 2.9, which we've drawn from our bank Santander. We also have very strong liquidity, and then we're generating cash from operations. We have a credit facility that we have agreed with Santander to September 2026 of 10 million, of which we only drawn 2.9. And as part of that facility, we also have an overdraft facility we could use should we need to in any sort of unforeseen events. So it puts us in a strong position financially to invest and grow for the future. And on that note, I'll hand back over to Andy to talk more about our very exciting next chapter.
Yeah, so the next chapter, the new era, which we're really excited about as a team. And we just flick on to the next slide. We've give you a quick intro to what we're terming the Vital Five as a management team. And these are the five areas of key focus for the team in this year and beyond. So number one, of utmost importance, is getting UK profitability back to where it should be, as Maria was just talking about. Secondly, a big part of the first of those initiatives, the growth and profitability, will be from the investment in the brands to drive growth. Really excited to talk to you about some of the work we're doing on the marketing front. The investments in the team and tech, doubling down on our franchising rollout, and the development of the brand internationally. So we're going to go into each of these just now. So the first one, the UK profitability, as I say, crucially important. We want to be able to fund our rollout from our own cash. That's a fundamental philosophy of the business. We've never really had any high levels of leverage, and we want to get back to that principle. So we're going to be leveraging a lot of deals that we did last year. So we made a lot of inroads in the second half of last year with our suppliers. And I would say that the biggest reason we were able to do that was our scale. When you've got scale, you become very important to your suppliers. When you're all in all parts of the country, you become a necessary element of their business. And it's important then to enable us to get the best possible pricing, which is fair. Hedging strategy on food and utilities, as Maria mentioned, will be flowing through into this year. We've recently revised our delivery partner strategy. There is a question in the Q&A, why did we do this? Well, we looked at our existing strategy, and what we found really when we went multi-platform is it did boost the sales a little bit. But the Venn diagram, if you look at the customers, overlap between some of these delivery partners is quite substantial. So you push one of the channels, and then the sales go up on that channel, and they go down on the other. And so what we did is we went with the two channels which have got the least overlap on that Venn diagram of customer, and we felt they were the best place in terms of the firepower to drive our sales in the future. We went through 6 months of testing and learning, giving them the opportunity to demonstrate this in different zones, and we went with Uber Eats and Just Eat, and we're really happy with that decision so far. So really crucial to improving profitability there as well. There's further opportunity to drive some operational efficiencies. This is predominantly around our labour deployment. It's not us removing hours from the business, but it's redeploying hours to the hours that we need them when we're trading, and finding clever ways of reducing the hours when the stores are less busy. And then lastly, the beneficial impact of sales growth. Anyone that knows this sector and the fixed cost nature of what we do, the top slice of profit when you get those sales coming up through is just flows through really nicely to the bottom line. So that will have a huge impact too, which I guess then leads nicely onto the marketing side of things. So what you'll see from this graph, the maroon bars show you the awareness of various businesses, and if you look to the right hand side, there's a number of businesses listed there which sell different type of food, but they're a similar size to us, and their awareness is significantly higher, which isn't right. We don't want a brand and sell something that nobody knows about. And in fact, when I go around new towns and cities to meet people and go and pretend I don't know where the Tortilla is, and I just ask members of the public, I'd say 2 or 3 people out of 10 max know where Tortilla is and know what we are. What an opportunity. If we just get people to try our food, we know from this graph that when they come, they convert. So it really gives us a strong belief that investing money in what was traditionally more of a word-of-mouth style marketing strategy, where we're relatively low-key on it, and it's fabulous that we've been able to grow the business using that approach. But now, because we've got national scale, it makes sense to crack on with marketing, and that's what we're going to be doing. And that starts with things like the video I think we've got on the next page, which this sort of thing. What an event and what a day. I mean, I wouldn't be surprised if that was the most burritos ever eaten in this country in a day. I mean, it was absolutely packed. We gave away 27,000 people, 27,000 burritos in store. We made sure that the customers signed up to our loyalty program, because loyalty is a big part of our future. We got 14 million people looking at what we were doing, and we were the second ranked term on Google on the day. So it's that sort of awareness. You're going to see more of those sorts of things from our brand, because we want to get the food into people's hands, because we think it's a great product. We know it's a great product. When they try it, they'll come back. We're going to be doing a lot on loyalty this year. So you can see there some statistics around how we've grown that in recent years. And we're going to be putting in a new loyalty platform into the business in June this year, which is going to be fantastic too. It's got a lot more capability than our old system, and we're going to have a big push on loyalty. You can see that loyal customers frequent more than non-loyal customers, and then they spend more too. So it's going to be a big area for us, and it's going to create lots of excitement and energy. As I said, I like the energy side of things. So coming on then to team and tech, we've got a really strong board of directors. You know, how lucky is it we've got such a great founder still in the business like Brandon is. We've got great other board members that all bring different things to the table. Maria coming on board on her strong skill set, really excited about the way forward on that. We've strengthened the management team, the exec team underneath, and James, we've a guy called James Garner will be joining the business in June as our food director. It's a real step up for us on the food front, where we're going to be doing a lot more innovation, products, collaborations, and just being a bit more exciting with our food. James comes from a business that's really highly regarded for its food, Honest Burgers, and we're dead excited about him joining, and going to see a big step change in our food quality from that point onwards. We're already working on some stuff now, so as a customer you'll start seeing things coming through in the stores shortly. It won't be an extension of the menu. We don't want to have a big menu with lots more menu items. What we're talking about here is just creating more food news and evolving our current recipes. We're going to be pushing loyalty, as I said there. We tested a kiosk last year in the site that we did that in. We've seen a significant reduction, 7-minute reduction in the customer journey of that in that site, because the queue was out the door down the street. Now people come in, they tap it on the screen, and they're out the door in just over 2 minutes. How fantastic is that? So there's loads more opportunity to do kiosk screens in the estate, and we'll be doing that. Data visibility and some of our data warehousing we're working on. And then operational efficiencies, as I talked about, we've got a labour deployment tool that we're looking at, and we're playing around with some different ideas. So really exciting on the team in tech. What a business for growth. We've done a lot of growth over the last few years. In fact, in 2022, we doubled our IPO target and did 18 sites. So that was fantastic. Last year, we did 7, 6 of which were company owned. We did 1 franchise site. And then this year, we're going to be going up to 8 sites. But there'll be a key difference this year. 3 of those will be corporate, 5 of those will be franchising. The reason we're going to do slightly less corporate stores this year is we've got a really strong pipeline of franchise sites. And we want to make sure that the management team's bandwidth and focus is on executing the food, the marketing, the profitability. These are the key pillars that will set us up for success in the future. And it feels only right to take a slight slowdown, given we've got the franchise business firing 5 sites through this year. Seems a really sensible strategy, and we're going to be looking at our future rollout plans. Obviously, Maria's only just joined the business. We'll be looking at how we can evolve that mix of openings in the future, and we'll report on that back in a future date. So we're going to be opening a really great site this year of the 3 in Manchester, Arndale, top quality shopping centres. We're going to be going after top quality locations with the highest footfall. So those are the 3 sites this year, and they will all be grade A's. So moving then on to the franchise, I'm really excited about this. It's something I've always been a big believer in. Our model is absolutely perfect for franchising, and the key is get quality franchise partners. And I led on the deals with SSP back in the day, 2019, we did that deal, and Compass. I've always been a big believer in this, and I still am. It won't mean that we don't open our own sites, but what it will mean is that there's opportunity for us to grow faster in certain locations. And actually, it opens up a greater white space opportunity for us than it would do if we did our own corporate rollout. So in terms of white space opportunity, a big tip when it comes to franchising. But the profitability of it is very good for us. You know, it's capital light. We talked about the fact we don't want to build up a big debt position. It only makes sense to do more of this, and we will be looking to accelerate with our existing partners and look at finding some new partners that we can trust with our brand. That's the key thing when you do franchising. You have to get high caliber partners. It's not necessarily the big corporates, it's the people that care and do a good job of serving your food and the customer service, and we're going to be looking for those businesses. So lastly, and it seems like it's unfair to put it right towards the end of the presentation, but what an opportunity there is across Europe. We've talked about this for a while now. It's still on our agenda. There's an amazing opportunity to grow burritos across Europe. We are more than twice the size of the next nearest business, as you can see on here. And obviously, as we mentioned earlier, we're a lot larger than our UK competition. So it gives us a tremendous opportunity to build on what we've done in the UK and look at the European opportunity. It will be mostly franchising. I've noticed one of the Q&A that's come in asks about that. We don't have the capital to do a corporate rollout. It doesn't make sense for us to do that. It will be franchising, but we want to control the supply chain. And to control the supply chain, it's really important that we get a central kitchen built somewhere, and we can control the supply chain and provide high quality food to our franchisees. That's what succeeded in the UK, and that's what we want to emulate in Europe. And it may be that we look to build a small corporate presence of our own. It's much easier than if you're doing that, because it justifies building your central kitchen, and it's much easier to sell your franchising. And I know this because I dealt with Compass and SSP in the day. It's so much easier if you've got supply chain set up. If you've got a box economics, you can say, right, here you go, here's the bit of paper. This is how our estate performs. If you go in with a blank piece of paper and an idea and a brand that doesn't have any equity in European countries, it's much harder. So it makes sense to get a proof of concept there. So it will be largely a franchise-led rollout, but we're looking and discussing all sorts of options and ideas. And I'll be really excited to come back one day in the future and hopefully talk to you about how we're going to achieve that. As you can see here, the market opportunity is big, QSR prediction in terms of growth and Mexican cuisine. So I guess if there is a single investment thesis for Tortilla, if you believe in the opportunity of Mexican food in Europe and you think it's going to grow, and you believe in us, the management team, we've got the best position at the moment. We're in pole position and we intend to win that race. So it's a great story and we're really excited.
Thank you, Andy. That's very exciting. So just looking at a little bit more about our sort of current trading and outlook for this year. Trading as it stands today is very much in line with our management expectation. Q1 saw a like-for-like decline of 4.7, but that was what we expected considering the switch in delivery strategy that we have talked about. And the early signs of that is that that's completely the right decision because we can see the profitability, the conversion of that being in line with what we expected. And we're also seeing, the profitability conversion of all of these margin improvements that we did last year now coming through straight down to our bottom line. And that's something we expected to keep seeing throughout the rest of the year to really leverage on those 2023 initiatives, as well as launching some new ones. We're making good progress on the rollout of our own stores. As Andy said, we're due to open Manchester Arundel already next month, and we have 5 franchise stores already confirmed to be open throughout this year. So the board and myself, we're all very excited about where we are at the moment and the growth opportunity of Tortilla, both in the UK and abroad. So just to really summarize the new chapter that Andy has talked about, it really is a new chapter in the way that we put a really strategic focus on our sustainable, profitable growth, both in 2024 and beyond. And we will deliver this through improving our margins, really leveraging on our 2023 improvements, as well as looking for new sort of end-to-end improvements so we can enhance it further. We're investing in the brand to really push and drive our top line growth through our like-for-like sales, investing in marketing and foods, as well as technology to drive efficiencies and therefore our like-for-like sales. This is whilst we're rolling out our own stores in those top grade A locations and really then accelerating the growth through our franchise model, both in the UK and internationally. So thank you very much for listening, and we're going to open it up to the questions now.
Perfect. Maria, Andy, Brandon, if I may just jump back in there. Thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the company takes a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Andy, Maria, Brandon, we did receive a number of pre-submitted questions ahead of today's event. And as you can see there in the Q&A tab, we've also received a number of questions throughout your presentation this morning as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. And guys, at this point, if I may just hand back to you to read out those questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Well, I think the first question on there was about Europe, which countries we're looking at. So I guess just to start with that one, because we're struggling to scroll down. So Europe, as I said, really exciting. Where are we looking at? It's where you'd expect. The Western European nations are the obvious target. Most food trends come from the US into the UK and then into Western Europe. As I mentioned on the slide where we talked about the competition, the burrito competition in Europe, you'll see most of those are in Western Europe. It's a market that we've seen it working in already. So it's the usual suspects on that side of Europe. I think there is eventually an opportunity in Eastern Europe, a sort of wave 2, if you like. But the priority zone will be, in terms of a wave of sites in Western Europe, would be the primary target for us. So the second question, I don't know, do you want to take the second?
Yeah, so the second question is about Richard and the transition that took place. I recruited Richard in, I think it was September 2013, and he started in March 2014. And he approached the board quite some time ago. This question makes it there's probably an implication from the outside that it took place quite quickly, but it didn't really. He came to us and said, look, it's been a decade. I'm closing in on 60. He is still a young man, certainly a vibrant man, and he wanted to start to consider a transition. And so it took some time to just get our head around making sure that we had the right structure in place and the right support, and how, if Andy was moving up into a CEO role, what we would do in order to make sure that we backfilled, and recruiting Maria, who we're delighted to have on board. And so that's been that's been in the works for quite some time, and certainly wasn't hurried in any way. And Richard actually was, as you can imagine, offered a position on the board moving forward. He decided he wanted to take some time off. It's important to remember that Richard has led this business through Brexit, through COVID, through a war, through an IPO. It's been grueling. And so, our thanks go out to Richard for all of his service and contributions, and from taking us this business from 15 to 80 across the international estate.
Yeah, I mean, I guess on a personal note, I'm sure Richard is listening in on this. I wanted to say thank you, because, we've really journeyed through this business together and done a great job. And for me, it's been great to talk about succession for some time. And as I said at the start, I'm absolutely delighted to be running this business now, and to have such a strong group of people to work with going forwards. So then the next one is, have you considered? Yeah.
I originally met with the chair at the time of Chipotle in about 2011, I think it was. At the time, they didn't have any plans to come to the UK. They did say that if they came to the UK, they didn't want to modify their model in any way. They wanted to have a model that was consistent with the US. We feel that the model in the US is very different. The average sales volumes are higher. You can drive to these types of locations, and it can operate in a certain way. Rents in the UK and in Europe are higher. There's not as much land. It's at a premium. And so it needs to be modified in order to have a different set of seating, a different kind of assembly line, a bit more flexibility. And so when we've talked to Chipotle in the past about their model and their structure, I don't believe that they would look to acquire. They've never grown organic. They've never grown through acquisition. They've only grown organically, and our model is sufficiently different that it probably would not be an easy fit into their portfolio.
So the next question was, can you give a bit more detail around why you opted to leave Deliveroo? Obviously, I've talked about that in the presentation. We went through a rigorous 6-month exercise of getting Deliveroo, Uber Eats and Just Eat to demonstrate what they could do to supercharge sales in certain locations. And we were very impressed with Uber Eats and Just Eat. Deliveroo did a great job for us, and we'll always be sort of thankful for how they've operated as a really good business partner for us over the years. They were our original delivery channel, but Uber Eats are really investing in the UK market, as are Just Eat, and we felt that they were the right, in terms of the commercials as well, we were the right partner for us for the future. We always, want to keep on good terms with people, and hopefully there'll be some more delivery businesses to create some more competition in the UK come in the future years, but we're really convinced we made the right decision on that.
We'll take the next question.
Yeah.
The next question is, at what point does Tortilla begin to reach mature sort of gap margins and become self-sustainable and profitable? So I think to that, whilst it looks like we didn't have the best year in 2023, it was a recovery year, and we used to be in that position in the previous years. So with the push we're now doing on our top line for our driving marketing and food and technology, really pushing the top line, as well as the things we've already done on profitability back in 2023 that we're really leveraging on this year and switching the delivery platform. We quite hopeful that we actually get to that already in 2024. And our aim was always, I think at IPO, to get around 10% sort of EBITDA as a margin percentage. We're around 7% at the moment. And with the slightly more focus on our franchising as well this year, we through 2024, we should be getting back to a position where we are self-funding to roll out our own stores. And how that then we get to that 10% and maybe even beyond depends really on the mix we're deciding to have between own store rollouts versus franchise. Because obviously when we open own stores, in particular outside of London, it takes a little bit longer to mature where the awareness is lower.
So the next question then is, will you ever offer a true, in quotation marks, Californian burrito, one with fries inside? I don't know. We're going to look at lots of different ideas.
As a Northern Californian, where we don't have fries in our burritos, I'd say we're doing the actual true California burrito, but I do know that the Southern California folks like fries in their burritos. We have introduced some fries. We need to get it right with the equipment that we use to hold those fries, and then we have the ability to be able to do California burritos, and that's something that we're working on.
We've answered the next question already, actually. It's a repeat. So then there's one there. If management, well, it skipped around, sorry. Where's that now? If the management team truly believed in the potential of the Tortilla franchise, what was the point in acquiring Chilango rather than viewing it as investing as much money as possible to grow Tortilla? Well, the Chilango deal, Chilango was a brand. If there was one brand that we looked at in the UK and thought, oh God, they're really good, it was Chilango. So the thing for us, Chilango was a strategic acquisition to take out a competitor that we felt was a strong business. But probably the most important thing for us is we felt that we could get that at a really sort of good price, and that they had a really good set of sites in central London. Most important of all for us, that was a property play really. And we are delighted with that acquisition. The sites that we acquired have generated nearly 900,000 of EBITDA last year. We paid 2.75 million for the business. Those sites will go on to further growth because London is coming back in a really big way. So it's looking like when we ran the numbers, it was too good an opportunity to kind of skip on.
Just to touch on that, we build stores for around 400,000. We acquired those stores with proven EBITDA at 300,000. So it was a belief in the future of owned stores in great locations, and it's worked out incredibly well.
Do you want to do the next one, Maria? Yeah, I can't read it.
The company has almost 40 million in total debt versus less than 1.5 million in cash. Okay, so if you're looking at the 40 million in debt, I'm assuming that that's then you covering in our lease liabilities and working it out on an IFRS basis, which I guess if you recognize it that way, you also have the assets from the lease side. So I would more focus on the fact that the true actual debt that we have with our bank, which is 2.9 million, as I said, which is really low leverage if you compare with most businesses. I wouldn't be concerned about the way we recognize our lease liabilities because they also have the right to use recognized as an asset on that.
I think this is kind of in the news around WeWork and the amount of liabilities that are in the future without proven revenue. It needs to be considered that we have revenue that's going to be coming in from operating these businesses over time. And so I think looking at it as 40 million of debt is probably not the right way to view our debt structure.
Okay, there's another one on leases. Why don't we skip over that because it's a similar point. Okay. Can you provide like-for-like metrics based on the maturity of stores? I assume that like-for-like trends tends to be higher for newly opened stores and lower for stores to be considered mature. Well, I think if you look historically, one of the great things that has always been the case about this business is it doesn't open with a big boom and then the sales drop away and then rebuilds like a lot of casual dining businesses that open to lots of hype and fanfare. This business always opens at a lower level and then builds, and that building process, obviously with the word of mouth approach, takes time. And in some locations we opened the last couple of years where the brand is completely new, it is going to take time. That's part of the journey about understanding burritos again and the consumer to understand that. Clearly, once what you can see when you look back at previous openings is once the local population really understand what we are, at some point it catches on and those like-for-likes do just start cracking up pretty quickly. But a steady state EBITDA before the crazy days of COVID and all the noise around that and everything at the moment, we always outperform CGA Peach, and we traditionally hit sort of 4 to 5% a year, which was a modest amount of pricing and some volume growth. And that's where you want to be as a business going forward as well.
The next question says 1.5 million of free cash flow will be sufficient for 3 to 4 store openings per year. Is this the rate of growth that you're going to use going forward? If not, how will you finance an accelerated store opening plan? So first of all, 1.5 or I think 1.6 million of free cash flow was the 2023 free cash flow. as we said, we have a lot of plans in our new chapter to drive our top line growth and our profitability and that will obviously follow through to free cash flow. So firstly, I'm confident that we will generate more free cash flow going forward. In 2024, we already said we're only focusing on opening 3 new stores in those really great A locations, which also normally converts quicker than if you open outside in tertiary or secondary sort of towns. So again, that will flow through to free cash flow quicker and have a quicker payback as well. So the free cash flow will grow over time. How we then decide to fund going forward, how much we're doing our own stores versus franchise is something, as I said, I'm completely new to the business and is new as a CEO. That's something that we're discussing and agreeing on at the moment. And it might be that we're driving the franchise side slightly harder, which obviously is a capital light model and also a very good model to accelerate specifically in areas that's a bit further away from where we already have stores, to getting the franchise side to own a certain area of the region, for example, like the south coast or a part of the West Country or something, and really accelerate in the area where they have the knowledge and the network.
So there's another question here now on the Google ratings and what is our approach in regards to responding to those. It's a really interesting area. I mean, our Google reviews are very good. If you look at our scores, they're typically a lot higher than our competitors. When we get bad reviews, we try our best to reply to them all, and we devolve that responsibility to the site level team. We have weekly reports where we look at negative reviews and any trends, and we try to deal with any underlying operational issues that resulted in those. But then you can't keep every customer happy, unfortunately. Sometimes they just had a bad meal, and whatever you do to them, you can offer them a free burrito voucher to come back, and sometimes they will, sometimes they won't. So we do try and respond to all negative Google reviews. Sometimes we probably don't catch all of them, and you may have seen some examples where we don't.
Excellent. How do you think about return on capital, and is it just about increasing store count or about decision on individual sites? I would say we're aiming for a 30% return on capital, but how we see that when we're looking at stores is very much on a store-by-store basis, and we actually proven that some of our stores that requires the most capital are actually the ones that are the most successful, because that means you can get the stores in those great A locations that we're really looking for, which is, for example, shopping centres or in the city in London and so on. So we're not afraid of paying slightly higher capex, because we know that would get us into those locations, and we can then generate a really high sales level and therefore a return on capital quicker. But equally, sometimes you would go for smaller locations, but then you would expect maybe outside of London that return on capital would take you slightly longer than what it would in an area where the awareness of tortilla is much bigger.
So there's a question then on Luke Johnson, who acquired some shares recently. There's a question as to whether he'll have an active role within Tortilla. The answer is no. We haven't met with Luke yet, but we don't comment on individual shareholders. But Luke is a shareholder like anyone else, and we look forward to meeting with Luke and discussing the business with him and his thoughts as well. Can you confirm the expected timing to open the franchise locations 2024? I'm not going to give specific months, but by the time we report back in September on our interims, I would expect most of those 5 openings to be open by then. So they will be sort of mostly weighted towards the first half of this year. There's a question from Henry around Chipotle going strength to strength. Do you want to take this one, Brandon? Any indication on their UK strategy?
Chipotle have been increasing the number of stores that they have. We believe that we have a strong advantage over them, but it's one of those things that we don't really want to publicly state too much, because it may give them clues on how to adjust in order to compete better. They have had some historic strong losses. They've taken some pretty high profile sites with very large premiums and rents. But we do think that they're doing okay now. Yeah.
There's a question from Paul here on the loss-making nature of the business. Obviously, Maria talked a bit about that earlier.
Yeah, so obviously we're not proud that we're making a loss, and it was loss making. Completely correct. If you're looking at the bottom line, we lost 1 million last year, and it was loss making the previous year as well. It's obviously we're still recovering from unprecedented times during COVID and that cost of living crisis, where inflation has been, as you saw from the graph I showed earlier, rocketing high, and we are in that recovery phase. And I'm really confident that with the plans we got of the new chapter, the push we're doing behind food marketing and technology this year, and the profit conversions we're already seeing, proof of this in our Q1, and we're having those profit conversions coming through, and the change in delivery strategy, we will change that around to become profitable.
So a question here then from Paul around him hearing that delivery aggregators are very greedy. I say that with a smile, and take most of the profit, and then essentially, is it worth even trading with them? The answer to that is it definitely is. I mean, one of the big things that delivery has helped Tortilla with is raising awareness, because you're on a platform that reaches lots and lots of people. But most importantly, the model is really well suited to delivery, because delivery is largely evening led. And traditionally, if you look at Tortilla's growth over the years, it's really been more of an in-store lunch-led experience. People see it as a sort of equivalent of a sandwich in the UK. We don't have that late night culture that they do in California, where people eat burritos into night. We are building that, and we'd like to see more of it. But delivery has complemented that strong position at lunchtime with some really good growth in the evenings. So it's definitely an accretive revenue stream for us. Of course, you've got the challenge of the dilutive effect of the profit, but we do charge more on delivery. So we try to get, in pound terms, parity, even if in percentage terms you're charging more to make the same pound profit. It's just the way that the market's moved. I don't think delivery is going away. I think it's going to get bigger. In 10, 20 years' time, I suspect the sales mix from delivery will be a bit higher. But I think our business model is really well suited to capitalize on that growth.
Can I just touch on the Chipotle question one more time, as some things came to mind? One important differentiator is just the flexibility that we have in our model. We do not have as high a CapEx, and we do not require as large a set of sites with as much kind of free spacing between seating and everything as Chipotle do. That allows us to have more flexibility in terms of the sites that we can go into, and therefore allows us to, we believe, expand faster. Also, Chipotle doesn't franchise. They are doing a franchise in the Middle East, but they haven't franchised in Europe in any way. Having a franchise model allows us to expand faster. So for all those reasons, we believe that we're going to continue to expand at a faster clip than them and win the overall race.
There's another point from Paul about the marketing in Bournemouth. I'm very pleased that you are in agreement with the strategy, and your point around should we give away samples, bite-sized burritos. Yeah, that's absolutely what we're trying in some locations. So it is more those types of things. We need to get the product into people's hands. We need them to understand what tortilla is, because we know when they try it, they come back. So yeah, really chuffed that you're in agreement with that. I just had a look at the time, and I think we're wrapping up actually now. It's 10 o'clock. So we probably should finish up. And what we'll do is we'll come back and answer some of these questions. I think we can type some responses when we get some time to do that.
Andy, absolutely, and Maria and Brandon as well. Thank you very much indeed for addressing all of those questions that came in from investors. And of course, we will give you back all of the questions that were submitted today, as well as any further ones that do come through. We'll give you those back immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But Andy, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Absolutely. I don't know if my mic is muted, but yeah, no, we're good now. So yeah, I guess the wrap up is hopefully our passion and belief in what we're doing presents well to you. We really believe in the burrito opportunity. In Europe, there's loads more white space, and we think we've got a really good strategy to get back, as we talked you through the pillars, get back to where we were and keep the growth going. We believe there's a big opportunity in Europe. And as I said, we are a long way in terms of scale ahead of our competition. So if you believe in burritos, you believe in the importance of scale, you believe in the opportunity, and you believe in the management team, then you should very much believe in what we're achieving in Tortilla. And that's it really. And I appreciate all of your time. You know, and we'll come back on any questions, and maybe we'll meet some of you in time too.
Perfect. Andy, that's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Tortilla Mexican Grill PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.